Hi and welcome to Swissquote's Daily Market Talk. It's Friday, May 2nd. The S&P 500 gained for the 8th consecutive session despite a set of soft economic data and cautious earnings forecasts. The no escalation of the trade war since a week now and dovish Fed expectations certainly explain a big part of the recent gains that we saw in US equities. But that optimism remains fragile, and the Fed's ability to help the economy depends on the inflation's trajectory. So we will dive into the latest news and projections in this video. But before we do, keep in mind, please, that opinions that I will be sharing in this video are my own, and this is not financial advice. Have you noticed that it's been roughly a week now that we haven't heard further escalation of the trade war? I'm sure you did. There are, of course, news on the wire about the trade negotiations between the US and other parts of the world. Some are more encouraging than the others, but it's been roughly a week since Donald Trump and his administration haven't added fuel on the trade fire, and it feels good. And the immediate relief from that sweet calm leads to a rebound across equities despite mixed news. Mixed news because Meta and Microsoft, for example, announced stronger than expected first quarter earnings earlier this week, as did Amazon and Apple yesterday after the closing bell. But statements from Apple and Amazon both sounded somehow cautious, more cautious than expected by analysts at least. Apple, that found itself in the crossfire between the United States and the Chinese trade war, saw a 2.3% decline in its iPhone sales to the Chinese in the first quarter of this year, whereas Amazon gave a soft guidance for the current quarter. The company highlighted that tariffs and trade policies actually make forecasting earnings complicated. I bet they do. Complicated indeed, when nearly 20% of goods that you sell on your e-commerce platform comes from China, and around 60% of the third-party sellers have an exposure to China, according to Morgan Stanley analyst, remember. And China is imposed at 145% by the Trump government, and Chinese are not willing to pay for these tariffs. They want to pass them on to the American clients. So both companies, both Amazon and Apple, fell more than 3% in the after hours trading, but US futures are still in the positive territory this morning, with Nasdaq, however, lagging behind the S&P 500 futures. Now note that this optimism is cool, but it is somehow fragile, as Amazon is not the only company out there that finds making forecasts complicated for the coming quarters. In fact, many companies in the S&P 500 and in Europe softened their guidance this earnings season, if not refrained to give a forecast altogether. Companies like McDonald's and Starbucks, for example, saw their sales decline in the first quarter of this year. That's perhaps an indication that households in the US and around the world are probably preparing for higher prices, especially in the US, guys, and recession, as the latest consumer surveys in the US all pointed at sharp decline in consumer sentiment, accompanied by a significant rise in medium to long-term inflation expectations. And indeed, the first glance at the first quarter official GDP data this week confirmed that the US economy contracted 0.3% last quarter, and price pressures mounted, and the second quarter numbers are looking dull as well. Yesterday's data from the United States warned that the manufacturing activity in the US shrank the most in 5 months in the month of April. Orders are falling, obviously, since the start of this year due to the tariff uncertainties. Production is diving as well, and the jobs in the US are, well, certainly coming under pressure. So the data released earlier this week actually hinted at lower job openings in the US, a soft ADP report, and also a jump in initial jobless claims to the highest level since February this year. Today's official jobs data from the US is expected to print 138,000 new non-farm job additions last month. Now, Note that last month's NFP report came in surprisingly strong, above the 200,000 jobs mark. But the way things are going for the US economy right now and the weakness of the economic data recently suggests that there is right now a greater chance that we see a soft jobs report from the US than the contrary. Of course, soft jobs numbers are not that bad. They could actually fuel dovish Fed expectations, and the dovish Fed expectations fuel risk appetite across the board. As such, the declining two-year yield of the United States explains a part of the recent rebound that we saw in the S&P 500 index. Yet there is a red line in the sand that shouldn't be crossed, and that's inflation. Yes, inflation, because if inflation heats up in the US due to tariffs, and it may, the Fed may not be able to give the necessary support to the US economy right away, and that could rapidly reverse sentiment across the risk markets. Therefore, a soft NFP read could eventually fuel the Fed dose today and push the S&P 500 higher into the weekly closing bell if the wages growth remains reasonable. Note that in all cases, the Fed is expected to maintain its interest rates unchanged when it meets next week. But expectations for the June FOMC meeting are quite close, with activity on Fed funds futures suggesting a 58% chance for an interest rate cut in June and 42% chance for a no cut. And inflation will eventually determine toward which side, which direction the balance will be tilting. In the FX markets, the US dollar was better bid this week, though the greenback is somehow softer in the Asian trading this morning. The euro dollar is back to the 113 mark at the time I'm talking here, after easing to 112.65 yesterday. Now, this week's CPI update from the Eurozone economies hinted at higher than expected price pressures last month. The Eurozone's aggregate CPI number is due this morning. Now, a stronger than expected CPI read in the Eurozone could eventually soften the European Central Bank dovish hands and lead to a further retreat in the euro. But at the end of the day, the euro dollar's trajectory will highly depend on the US dollar's performance, mind you, because easing trade tensions could well lead to a US dollar rebound across the board and lead to a period of consolidation for majors. And I think that nothing else than easing trade tensions should give the US dollar a sustainable rebound. Now, elsewhere in the financial markets, the no escalation of the trade war between the US and the rest of the world and the improved risk appetite as a result of it pulled gold prices lower throughout this week. As such, the price of an ounce of gold hit $3,200 per ounce yesterday after trading near the $3,500 last week. So even gold is super volatile right now, while the dollar franc printed a double top near the 0.8335 level that could be easily broken, however, with the escalation of the trade war. Crude oil, on the other hand, was sent on a roller coaster ride this week. The barrel of US crude tanked below the $57 per barrel mark yesterday on news that Saudi Arabia is ready to tolerate lower oil prices and has even pushed for an unexpected output hike in May. But then the dip buyers in oil rushed in as Donald Trump threatened to widen sanctions against the buyers of Iranian crude. Now, I find that the day-to-day moves in oil are challenging to catch, but the outlook, the medium-term outlook for oil remains comfortably negative on higher supply and lower demand prospects, and I eventually think that the US crude remains on track for a deeper fall toward the $50 per barrel target. Now, lower oil prices will likely take a toll on energy companies' earnings these days, and BP actually did announce lower than expected first quarter results when it announced its earnings earlier this week, and also reduced its stock buyback program due to economic uncertainties, while the company also has some reshuffling issues inside. But Shell, Exxon, and Chevron are also due to report their earnings today, and Exxon and Chevron, they're both expected to announce an EPS decline between 15 and 20% due to lower oil prices. In fact, the energy stocks are doing quite poorly despite an initial Trump boost that we saw in November, and the falling oil prices across the globe, trade war, and economic uncertainties that come along with the trade uncertainties hint that the oil companies could actually remain under pressure before seeing better days. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.